Building wealth in the stock market is super easy to do. Well, in theory. The issue is human nature and the lack of patience. Taking advice from the wrong people and getting caught up in the latest news cycle. As we're seeing right now, we turn on YouTube, we turn on the TV, all we see is talks about the latest recessions, more banks potentially collapsing, basically doom and gloom wherever you look. But investing in dividend growth stocks can actually give you a peace of mind. As a dividend growth investor, you're shifting your mindset from a short-term speculator towards becoming a true long-term investor and business owner. I myself feel as the owner of a company because technically I am. I own a share in that company and they pay me a dividend in return. So there's really no difference to being a co-owner of a company where you just happen to own a bigger part of the pie, or being a shareholder of a dividend growth stock where you get dividend payments paid to you in return for your ownership. And the great thing is here, you really invest in the business, in the long-term growth and success of the business. And this way you avoid having to chase the latest price movements of a company or the overall markets, because life is cyclical. Things go up and down. That's the nature of life and business as we know it. But in the long term, successful businesses will sustain. And we really talk about companies that have been paying dividends for over 20, 30, 40 years in a row. So they have gone through countless amounts of crisis and weathered the storm. So that definitely will give you a more peaceful sleep. And through reinvesting your dividends over time, you can really compound and snowball your portfolio growth. And I'll show you in this video how little amounts over time regularly invested can make you a multi-millionaire. With this, let's get started. Well, first off, when investing in stocks, everybody always competes to the S&P 500, the 500 biggest companies in the United States, because that's a great benchmark to see how you as an investor are doing relative to that. If you're outperforming it, great. If you're underperforming it, well, you're better off investing into an ETF that follows the S&P 500. So that's always a good base to look at. So just to show you the power of dividends, because obviously as part of the S&P 500, there's a lot of companies that are actually paying dividends. So when you look at it over here, these are the returns since 1977. If you wouldn't reinvest the dividends that you received by holding an ETF that mimics the S&P 500, you would have a portfolio value of $191,000. However, if you were to reinvest those dividends, you would actually end up with a portfolio worth $752,000. So you can see a huge difference that only dividends made. Also, this is a super powerful graph. You can see here the dividend paying stocks have outperformed the non-paying dividend stocks over time. This is basically the compound annual growth rate from 1986 until 2022. And here you can see dividend growers clearly outperformed with a compound growth of 10.8% across those years. And obviously you had a number of crises in between. Dividend payers in general would come as a close second, and that just means that they keep a stable dividend. But we obviously focus on dividend growth. So that means companies that grow the dividend, the actual dividend amount over time. So that's why they're actually outperforming that. Then you have S&P 500, basically the overall market as such. Here you have dividend cutters, companies that used to pay a higher dividend, but then due to various issues, obviously not doing a good job running the company, had to cut the dividends, and that obviously yielded in a lower return. And lastly, you have the non-dividend payers. And obviously these can be high growth companies, and that's great. You know, for a certain amount of years, they're really booming. Some of the tech stocks we've seen the last couple of years, astronomical growth. But over time, when you average it out, in general, as you can see, they actually haven't been performing as well. And that's another really reassuring graph in terms of volatility. As I said to you, I really want to have peaceful sleep with my portfolio, not having to worry when I wake up next day if my portfolio halved in value, which actually happened to my crypto holdings. And I'll continue to invest in crypto and more risky assets, but by investing in dividend growth stocks, I want to sleep peacefully, because that's hopefully one day going to be majority of my holdings. And that's why I don't want this to go up and down like crazy. That's where we talk about volatility. And here you can see obviously the dividend growth had actually the least volatility, meaning the least swings. The great thing about dividend investing, there is not only the dividends you get, but you're still going to get capital appreciation, because most of the companies, they do grow in value over time. Maybe less than those high growth stocks, but at least in bad times, you're still going to get a dividend. Plus, in the long term, the capital appreciation. And that's what a lot of people forget, because they only see a dividend yield of 2 to 3%. They say, well, that's not really a lot. But don't forget, long term, you're still going to get the capital appreciation on top of that. Same when you buy a house or apartment for rental. In the long term, you obviously have the appreciation of the real estate itself. In the short term, you have the rental income, which is the equivalent of the dividend. And with those two components together, compounding and growing over time, you really start generating some serious wealth. And that's just another powerful graph that shows you how powerful dividend growth investing can be, because you will have a peace of mind. For example, as you can see over here, the growth of the S&P 500 over the last 20 years. And you can really see we're living in the moment, so we get sucked into certain trends. And when everybody says you have to sell because the recession is imminent, people are starting to sell. You see here all these panic moments, and people do sell, and that's where they lose and materialize losses. If you would just hang on to it, you would have started here and you would end up here. Sounds so easy in theory, but we go through these cycles all the time and that's normal and will continue to happen. So people usually end up buying in the euphoria stage when prices are high, they get excited, they see the long-term potential, everybody talks about it. The same was true with Bitcoin, with anything really. People buy here, then things go south, they panic and they sell here. And that's where you actually end up losing money. You want to just hang on to it and get this regular cash dividend paid to you. And that just gives you confidence, even that when you see red, and my portfolio has been red quite a while in recent times, as most people's portfolio, because obviously the market has been downtrending. At the same time, I'm still receiving regular cash payments. And for me, that's really reassuring and gives me confidence that I'm doing the right thing here. This is just another graph highlighting once again, if you would have invested $100 back in 1980s, where it would be today. And obviously you can see the biggest growth would be from dividend growing stocks because they compound your growth over time, and you can really see a stark difference between the various stock asset classes that you could potentially invest in. And here you can see once again what I mean by getting this regular dividend income. The dark blue line over here is the dividends that you get. You get a certain return. And in good years, you will get a capital appreciation on top of it, the light blue over here, which is great. But you can see there's certain years where your capital appreciation is actually depreciation. There's a loss in value of the company for a certain time. But you will still end up getting dividends from the company because the company in most cases will continue to pay dividends, especially if they had a long track record of paying. They become a dividend aristocrat or a dividend king, which makes them really popular, like Coca-Cola, for example. They are a dividend king, having paid dividends for over 50 years in a row, in fact growing over 50 years in a row. So they would be very hard pressed to all of a sudden start cutting it, because all of a sudden they wouldn't be a dividend king anymore, would be much less popular, and there would be a lot of other consequences. So they would avoid that at all costs to cut the dividend. And that's why I mean, even if the price of Coca-Cola drops, you will continue to get dividend payment paid to you. And in fact, by having a lower share price for Coca-Cola, for example, you can actually get a higher yield, because then the dividend amount that you receive from the stock in relation to the stock price, which has been falling, the percentage of dividend to the price will be even more attractive. You can buy more of a cheaper Coca-Cola stock in that example and get more dividends in the future, growing it even faster. Another big benefit of dividend growth stocks is their resilience during periods of high inflation and high interest rates. Actually exactly the times we're in right now, which you can see historically over here, S&P 500 index, how when the CPI, the inflation, increased over time, also the dividend and dividend growth have been increasing over time to keep up with the higher interest. And even here you can see, following the month of Fed interest rate hikes, how the dividend growing stocks obviously grow the fastest in comparison with other non-paying dividend stocks. And this is a very good point they're making over here. Obviously, with high inflation and interest rate, companies that can continue to grow their earnings and dividends will be more resilient against inflationary concerns. And obviously we talk about high quality companies that have the competitive advantage and pricing power in order to pass on that inflation and price increase to their consumers, and therefore grow their income to keep up with inflation, and therefore have higher earnings and higher profits, which they can then share and pass on to the investor. One very famous example of how powerful dividends can actually be comes from, how else could it be, the legend himself. Warren Buffett's Berkshire Hathaway is actually the biggest shareholder of Coca-Cola, as you can see over here, with 9.25% ownership of the company. He made the majority of the investment some 35 years ago, when he invested a staggering $1.3 billion at the time, which was a huge investment. However, it clearly was worth it. Last year in 2022, Berkshire Hathaway received a staggering $704 million in dividends paid from Coca-Cola to them. That's what I call a great investment. Another great example about the power of reinvesting your dividends comes when we look at the historic returns of, let's say, McDonald's, which is a dividend growing company, versus the S&P 500. So when we purely look in terms of capital appreciation of the stock price, you can see here in terms of price return, the S&P 500 returned 54%, that's over a 5-year period, versus McDonald's 64%. So slightly better for McDonald's, but we might have been lucky by picking the right stock, so it's not really fair compare one individually handpicked stock versus the S&P 500, but still fairly equal, slight edge for McDonald's. However, the interesting part comes when we look at total return. So that obviously means with dividends considered. You can see quite a different picture. All of a sudden, S&P 500 grew slightly to 54%, but McDonald's, on the other hand, actually grew to 84% just by considering the dividend. And that really makes a difference. Yes, it might seem small, 2.28. People might say, well, it's actually less than inflation. But once again, the power comes from growing it over time and reinvesting. They've been growing it for 21 successive years, and the average growth over a 5-year period is 8.26%. So imagine yourself getting an 8.26% salary increase every single year. Probably quite unlikely, right? Maybe now because inflation is high, your employer might pay you a little bit more, but once inflation comes down, that is actually highly unlikely unless you get promotion or really get a big jump up. But this will be the growth every single year from the income you receive in form of dividends. So that's really assuring to see that over time they've been growing it for 21 years. Obviously, history is never a guarantee for the future, but it definitely gives me much more confidence than investing into a startup that everybody talks about as really hot today, but who knows what will happen tomorrow. Here you have a proven track record, and that's what I mean by sleeping peacefully at night. Let's also have a look at the dividend calculator where you can kind of project your future income and portfolio value. So once again, let's stick with McDonald's in this example. Let's have it as an individual company. Payout is quarterly. They're paying a quarterly dividend. Do we want to drip, basically reinvest our dividends automatically? We say yes, that's always advisable because in the beginning you don't want to live off your dividends, but you do want to reinvest them to grow your portfolio faster. Your starting share, let's for this example have 1. The share price is what it is at the moment. Let's say you have an annual contribution of $12,000, so that's $1,000 every month. Some of you might be more, some of you might be less, but I think $1,000 a month is a fair measure and achievable. Dividend tax rate obviously depends where you live. Some people in the UAE, for example, are lucky to have 0, but it depends on your tax jurisdiction. But in my case, let's have 15%. Some countries have a tax-free allowance per year, so you can put this over here as well. Then the initial annual dividend yield, which your company has. In this case, this is what McDonald's has at the moment. Here, the expected annual dividend amount increase, 6.17. That's kind of an average. As you see before, the 5-year was even higher at around 8%, but I want to be a little bit more conservative, so let's keep it at 6.17. That's really achievable and honestly quite doable for a company like McDonald's. Then the expected price share appreciation of McDonald's, that's obviously a little bit lower. Some companies that don't pay dividend would have a higher return over time because they don't pay dividend. Investors only benefit from an appreciation in price share, so that's why I keep that a little bit lower because they pay a higher dividend in return. So you can play around with this. You can put 1, you can put 5, but I think 3 is really an achievable number. And for this sake, let's put a 30-year invested period. I know it sounds very long, but you will see that's where the compounding growth effect kicks in. And here you will see the power of dividend growth investing. You will end up with an ending balance of over $1 million. I know it's a long period, but it just shows you also $1,000 is quite achievable. You just need time, reinvest and stick with it. If you would have moved in and out, you may not end up with this number, but if you let it compound over time, as you can see over here, the graph, that's when you start really seeing the results. And you would end up with an annual dividend income of $61,000. Now, obviously that might not be enough to live a lavish lifestyle, but honestly, that's still a nice base to have, passively paid to you money every single quarter just for being a shareholder in McDonald's. And once again, you could have invested more and that would look obviously immediately differently. And the great thing is really the compounding over time. You can see here in the beginning, it takes you almost 4 years to get an annual dividend of up to $1,000. 4 years. You say, well, it's not really worth it. And a lot of people give up way too early. But if you stick with it, you can really see how it compounds over time. Now, if I just go back to the same example, I keep all the parameters the same. I invest the same amount. I'm not increasing it. The only thing I'm changing is the expected annual dividend amount increase. Because once again, we dividend growth investors. We don't want to have the same fixed percentage of dividend yield paid to us, but we want to see that grow over time. So if I change it from 6.17 as we had before to 8%, now all of a sudden what you will see is my ending balance will be 1.3 million compared to around 1 million, so 300,000 more. But my annual dividend income will be 136,000, so more than twice we had in the previous example, just by a small percent of 2% higher growth. And that's the power of dividend growth. So once again, I really want you to understand how important the growth component is. And one last example to show you the power of time and growth combined. As Albert Einstein called it, the 8th world wonder, compound growth. And here you can see Warren Buffett's net worth. Actually, for most of his life, he was actually not that rich. Well, to be fair, at my age, he already had 10 million, so a little bit ahead of myself, I would say. But still, compared to what he's worth now, actually really not much. And only once he started to reach over 60, he started really adding wealth. How fundamentally it changed from 66 onward. With every additional year, he got exponentially wealthier. And that's just the power of compounding every time. And you don't get this by moving in and out of stocks and chasing the latest trends. As you can see, I'm really fired up about dividend growth investing. I know it's not as hot and shiny as investing in meme stocks or the latest crypto craze. And honestly, I still invest in other things. I still get my fun with cryptocurrency. I still invest in real estate. I have P2P loans. So I try to diversify as well. But investing in dividend growth stocks over time, I truly believe that even if the price swings go up and down, long term, obviously, good companies will grow. But going through the motions as we are right now, where the prices and markets tank, I still get my regular income paid from those companies to me. And that's just really rewarding to see. And that's why I don't have the need to log in every day, see what's happening. Should I buy? Should I sell? I sleep really peacefully at night, knowing that the majority of my money is working and compounding for me. And in this video over here, I'm going to run you through my dividend growth stock holdings. I hope you enjoyed the video. If you did, please give it a like, subscribe to the channel. It means the world to me. Stay healthy, get wealthy, and I see you in the next one. Ciao.